Most of you are probably aware that many central banks all around the world own gold. In fact, since the late 90s, central banks around the world have been net buyers of gold. That wasn't true before that. Coincidentally, that is also when the gold price bottomed, ended that long bear market, and began a massive epic bull market leading into a bubble in the late 2000s. But the question comes up, why are central banks buying gold? Because we know that they are printing paper money and telling everybody to use their paper money. But on the other hand, they are using that paper money to buy gold for themselves. So what are they planning on doing with all this gold that they're buying? And could gold revaluation be a part of this long-term plan? Have you ever wished that you could earn real gold and silver by spending your fiat trash? Well, now you can with the new Bullion card from APMEX and One Gold. The Bullion card is the industry's first precious metals reward credit card. This is very different than all those debit cards out there that force you to violate Gresham's law by stacking gold and silver, then selling it in order to spend more fiat. The Bullion card is different. It is a credit card that you use just like any other credit card. It allows you to spend your fiat, meanwhile earning gold and silver. On all purchases, you earn 1% back in gold and silver. If you apply through APMEX, these store up in points you can use to purchase gold and silver. And if you apply through One Gold, it allows you to automatically convert those points into segregated, allocated gold and silver, and then at any time request physical delivery through APMEX. This card has no annual fee, an introductory 0% APR, and your points never expire. This card is a game changer because it allows you to spend the fiat currency you are already going to be spending anyway, just as you were going to, and instead of stacking up those airline miles that you never use, and instead of using those measly points for cash back, no, you get to stack real, sound money, gold and silver, physically in allocated segregated accounts, or use it for purchasing direct physical precious metals from APMEX. And just like any credit card, it comes with many of the benefits that all credit cards offer. Pause here if you'd like to read more. I have both the APMEX version and the One Gold version linked in the description below. While we can find some clues from the governor of the Dutch central bank in this article from Gainesville Coins, where he talks about the balance sheet of the Dutch central bank being solid because they have gold reserves and the gold revaluation account being worth more than 20 billion euros. Now, we have to distinguish between two separate things here. Most central banks have something called a gold revaluation account, which I'm going to explain what that is. That's different than the price of gold being revalued at a specific price by central banks. Like I mentioned earlier, central banks all around the world have been stockpiling gold for a very long time, and that trend has only escalated recently. In fact, right now, we are seeing central banks with the highest level of gold reserves since 1975. This is held in gold revaluation accounts on central banks' balance sheets. However, in the EU, the law says that you cannot net your unrealized losses of one security on your balance sheet against something else like gold. So in plain terms, what does that mean? It means, let's say we're dealing with your own personal balance sheet. You've got your 401k here. Your 401k goes up and down in value with the stock market, whatever it is invested in. It from one year to the next fluctuates from $100,000 to $120,000 to $80,000 back to $100,000. Now, let's say on the other hand, you've got a credit card, and a credit card represents liabilities when you owe money on it. Now, let's say for whatever reason, that credit card decided that your credit limit was going to be exactly the value of your 401k. That would mean that in any given year, if you load up, let's say your 401k is worth 100 grand, you load up your credit card with 100 grand, next year the stock market goes down, you're suddenly underwater and you owe money to your credit card because now your credit limit is only 80,000. Now, because the EU wants to avoid this for accounting purposes, they tell central banks you are allowed to own as much much gold as you want, but you're not allowed to take that and net it against the value of your liabilities. Meaning that in your circumstance, it would say, hey, your liabilities, your credit card is going to be completely isolated. So your 401k could go up to be worth $1 million, but you cannot use that to net out your net worth against your liability, your credit card. And for central banks who are constantly printing money and getting themselves into terrible financial situations, if they were actually held according to regular financial rules like the rest of us, that would be very bad if suddenly the price of gold went up and they had room to suddenly create a ton more in liabilities. But specifically with the Dutch central bank, he's saying that if we were allowed to net that out from an accounting perspective, we would have a very strong balance sheet because of how much gold we have. The amount of gold, it's worth a lot more. Now, if push comes to shove, and it probably will because of the direction that most central banks are going, there might come a time when central banks need to use their gold reserves, or at least use their gold revaluation account as a way to offset their liabilities and show that they are still solvent, because the accounting rules don't allow for that yet. But that problem would still exist, that if the price of gold subsequently went down, then their liabilities would come right back, which would mean that the European Union or somebody would have to set a floor underneath the price of gold to make sure that all those liabilities were permanently wiped out and that that gold was there to represent the solution to the problem. Now, you might think that somebody would have tried this a long time ago, but it looks like European central banks have been spending the last few decades trying to all get on the same page with how much gold they have. And if you want to go down a really deep rabbit hole, you can look up Friend of Another. This was something he talked about, that central banks in the European Union were trying to come together and all get the same amount of gold. And really what it looks like now, the same author, Jan on Gainesville Coins, has pointed out that European central banks have now equalized their gold reserves proportionally to their GDP. This would mean that when they are ready to do this, they would all have the ability to revalue gold at the same amount, and it wouldn't disproportionately hurt or help any of their countries. Relative to their size, they would all have the same amount of gold with the same benefit for doing this. But you also run into a problem here, because as soon as you set a legal floor, an artificial floor under the price, or a price ceiling for the price of anything, you introduce market instability. Because prices are determined by the relative value of one thing compared to everything else. Prices are just information that convey how valuable something is compared to everything else that exists. Prices are the aggregate of the subjective value of the wants and needs of everybody in an economy. And so if you set a ceiling or peg a price of anything, eventually the free market will probably break that peg. And this is true whether you talk about a floor for a price or a ceiling for a price. Now, if you take a look at this chart that looks like it's missing data, what you're really seeing here is the pegged price of gold. Back in the late 1800s and early 1900s, when it was $21 an ounce, and then when it was revalued higher by FDR to $35 an ounce, because you had an artificial peg on the price, it was not actually worth that. So eventually that price peg broke and it was revalued higher to 35. Because prices are just the number of one thing that it takes to get the other thing. And the number of dollars it took to get an ounce of gold was $21, and they had printed too many dollars. So now they had to change how many dollars it took to get the gold, because that's what the free market was pushing. It broke. And obviously that peg held for a few decades until we get to 1971, and the free market broke that peg as well. Again, too many dollars were printed, so it took more dollars to equal the same value of 1 ounce of gold. And we know the temptation that governments and central banks face, because we see the consequences of them giving into those temptations over the past few decades. And so what would stop them from setting the price of gold at 1,800, why would they not go to 2,500? Why would they not go to 3,500? Heck, why would they not set the price of gold at something like $35,000 an ounce or even higher? Because that would not only just offset their liabilities, they could solve all of their funding problems for decades, right? Well, not necessarily, because number one, there are always going to be second and third order effects from artificially imposing prices on a free market that you cannot anticipate beforehand. Number two, this would represent a massive surge in purchasing power for the governments as they automatically wipe out all of their liabilities and give themselves additional purchasing power from their gold reserves. Now, as gold is the only real asset on most central banks' balance sheets, and their other assets are continually declining in value every day, especially now as they're trying to fight inflation, there may be no other way out for central banks, and they may need to do this at some point in the future. But personally, I'm not yet convinced that this would actually be a good move for everybody, as I'm too skeptical about what would happen if governments were suddenly blessed with a wiping out of their liabilities, a surge in their purchasing power, and really most of their citizens did not get any of that same benefit because, again, most citizens in the West do not own any gold. Further than that, it would artificially boost the wealth and purchasing power of countries in the East, like Russia and China, who the West is not particularly keen on increasing their wealth and power right now. But since we are now seeing people in charge of central banks, like not at the Dutch central bank, talk about their gold revaluation accounts as a way to solve their solvency issues for the future, it may not be too far forward in the future. It may be sooner than we think something like this could happen. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.